right now, let's focus on the quiz and stuff like that. And let me just go over the memo with you. Okay, we can really focus on that later. So can you pull out your memos? Can you pull out your memos? Do you have everything? You may want to watch the videos for the memos. Let me go through the memos really quick.
Do you have extra memos?
You know, I don't have really good memos because what happened is a bunch of people came to class, they took my stuff and they left and they dropped the class, so they stole my memos. Okay, but I do have two sets of memos. They're not great memos, but they're good enough for it to follow along. So, is it you two? You guys can fight over it. Okay, take pictures. And there's sets of memos. There's like 11 sets of memos up on the website. Okay. And again, if you didn't come to class, you should have like called me or talked to somebody. You know, I can't micromanage 40 people. Okay, so you gotta. I'll answer and I will help you, but again, you've got to kind of take responsibility. So here's how the memos are going to work. Okay, this is how they're going to work. Now you have in front of you, you're going to do the stock memo. Okay, the stock memo. I'm just going to do one. All right, and your format for the memo is going to look exactly like this. No deviations. 1-inch margins. Okay, 16-point font memo at the top, caps. They have to be aligned right here. This is your standard executive memo. There's got to be a small line underneath it. You got to basically tab over. Everything's got to be flush. The date to me, from you, and then RE is basically the statement. Now, the statement, the RE, very, very poignantly, it tells you exactly what the memo is going to be. Stock prices forecast to fall 10% over the next 3 months. Bam. What are you tracking stocks? What do you think is going to happen? They're going to fall. By how much? 10%. Over what period of time? 3 months. Now you got my attention as the reader. Then nothing changes here. We are tracking stock prices. Is that what it says?
Yeah.
We are tracking stock prices. That's it. Period. We forecast stock prices to fall 10% over the next 3 months based on the following factors, semicolon. Now it's the three factors. Rising interest rates, that's correct. If interest rates go up, stock prices go down. Bing. Falling earnings expectations. Well, if I think earnings are going to fall, or the growth rate is going to decelerate in earnings over the next 3 months, that's going to drive the stock price down. Okay, and lower gross domestic product. Well, if GDP is slowing or is contracting, we're going with it. So that's going to drive stock prices down. So I basically have two macro factors, interest rates and GDP, and one company or sector factor, which is earnings expectations. Got it. Therefore, comma, we recommend the following 36 trades. Okay. We are tracking 3 indexes, 3 stock indexes. We are trading off of 3 exchange traded funds, ETFs. And we are also trading 5 stocks. Okay. Now, if I think that the prices of the indexes, the exchange traded funds, the stocks are going to go down, these are the trades that I would make with the derivative contracts. So there's only 2 sets of derivative trades. When stock prices go up and when stock prices go down. That's it. Okay? And when indexes, the stock indexes, you think that they're going to fall, you're going to write forward contracts, you're going to write futures contracts, you're going to write calls on futures, and you're going to buy puts on futures. If you reverse it, and and you think the stock prices are going to go up, interest rates are going to fall, earnings expectations are going to rise, and gross domestic product is going to rise. What would your trades be? You would buy forward contracts, you would buy futures, you would buy calls on futures, and you would write puts on futures contracts. Okay, so there's only 2 sets. So 3 times 4 is 12. So I have a total of 12 trades for the indexes. We are also tracking and trading 3 exchange traded funds that are basically emulate and track the 3 stock indexes. The stock indexes are the Dow Jones, the S&P 500, and the NASDAQ. You can Google and say Dow exchange traded funds, and you will get Fidelity, JP Morgan, you will get Charles Schwab, you will get all of these broker dealers that basically manufacture exchange traded funds that basically track these stock indexes. Okay? And those exchange traded funds trade as securities backed by these indexes on the exchanges. Okay? The exchange traded funds were invented by BlackRock. Anybody heard of BlackRock? BlackRock, downtown San Francisco, 2nd and Howard Street, used to be Barclays. They basically control over $1 trillion in assets under management, $1 trillion. They invented that product, and they basically dominate the exchange traded funds market, okay, even though everybody else. So if I think the prices are going to go down, I'm going to sell short, I'm going to write calls, and I'm going to buy puts. If I think the exchange traded fund share prices are going up, I'm going to buy on margin, I'm going to buy calls, and I'm going to write puts. 3 exchange traded funds, 3 trades, total of 9 trades for the exchange traded funds. All that stuff doesn't change. I'm tracking and trading 5 stocks. In this case, we were doing JP Morgan, Microsoft, Wells Fargo, so we already have the tickers right there, the 5 stocks. The stocks in the ETF trades are exactly the same. So if I think that the stock prices are going to go down, I'm going to sell short, I'm going to write calls, and I'm going to buy puts. If I think that the stock prices are going to go up, I'm going to buy on margin, I'm going to buy calls, and I'm going to write puts. So once you've memorized the 2 sets of trades, depending on your forecast, up or down, the trades are basically binary. They're mechanistic. Okay. Then over here, you have the bullets that basically support your forecasts. On January 26, 2018, the Dow Jones reached its highest closing record. Since September 17th, the Dow rose from 21,987 to 25,709, up 16.92%. That now you're an analyst, okay? If you can put in a date, you can talk about the change in the index or the price and give me a percentage, boom, you're an analyst, okay? Under the Trump administration, interest rates are forecast to rise in 2018. The 10-year Treasury yield is expected to reach 3.3%, up 75 basis points. Gold prices rose from $11.54 per ounce in December 2016 to $13.34 today, up 15%. This shows more fear in the market due to rising inflation expectations. The Department of Employment, it should be Department of Labor, released a survey showing employment rose 2% over the last 2 years. Employment is forecast to reach 97%. The employment rate is forecast to reach 97% by the end of 2018. So basically it supports your underlying forecast. And then also, the graphs are right here. So you go up to big charts, stock charts, and you basically go back 3 years, and you copy and paste Microsoft or IBM or an exchange traded fund, and you plop the graph in there and center it. The paragraph at the bottom is just the intro paragraph. So you copy the intro paragraph, you paste it down here, and the only thing that you change in the conclusion is you change the semicolon to to a period, and you change following to above, and that's it. So why would I copy and paste the intro to the conclusion? Why would I do that in my memo?
Sums up everything.
Sums up everything
In the
again,
memo.
and basically you're hitting the reader between the eyes again, and basically confirming exactly what you told and you proved in your memo. So that's it. So if you wanna give a shot at the stock memo, go ahead and do it, Let me take a look at it, either next week or the week after. Use the language, don't get hung up on it, just focus on the format, replicate the logic, and then update the data and maybe update the graphs. And let me see how you do. Okay. Most of these memos, the ones that I gave you, most of these memos, hold on, I don't know why I gave you Kyle's, because there's a line missing. Most of these have been gone through with my TAs, okay? And they've been gone through with me, each of them at least 5 times, okay? And I always get a group of students at the end of the semester that's like, Professor Souza, can you look at my memos 2 weeks before the class is over? And I'm going, no, you gotta go talk to the TA, because I'm not gonna spend a month's work of review in basically 2 hours or 4 hours when you had basically 15 weeks to come talk to me to get your memos done. So there's always a group that don't take the memos they take them for granted and they don't think they're an important thing. Then when I get to the end of the class and I gotta give that grade, and I wanna give everybody a grade, but if you give me crappy memos, it's like, they didn't take me seriously. And the memos can't be used. And I can't give them to other students. And I can't give them to the dean. I can't give them to the chair. I can't give them to anybody else to show how amazing you guys are and what great work that you can do. I throw them in the garbage can, okay? Because I can't use them, and you can't use them. So basically, it was a waste of my time and a waste of your time, okay? So please don't waste my time. Work with me. Take advantage. How many people have worked with a managing director before? How many people have worked with a managing director with over 25 years of experience that have run multiple research departments for large pension funds, institutions, and individual investment advisory firms? How many managing directors have you worked with?
0.
0. How many do you want to work with right now? 1. Okay, 1. All right, so take advantage of me, okay, because I may not be around forever.
When we do this, do we choose any stocks? Or?
Yeah, you can pick, I would do the Dow, the S&P 500 and the NASDAQ is the index. You can go out and find and pick the exchange traded fund, and you can pick the 5 stocks that you want. No problem. And you can even talk about the stocks in your writing. And you can use the stock charts in your memo too. Okay? Any questions on the memo? All right, so let's do the,
Should we say indices or index?
you can say index, you can say indices. Indices are more appropriate. Okay. Don't say indexes. Okay. Say indices. All right, so how's everybody doing?
Good.
Okay. So let's try to get through as much of this as possible. I feel like this is going to be review. So do you have your blue book? Do you want to start taking notes in the blue book? To be able to use it as a study guide? So there's no surprises on the exam. So what is it, 8:30, 9:30? 8:20, 9:20. So let's do like an hour on this. All right, we already went through this. Right? It's the statistical pretest. When building forecast model, what are the first steps or questions that need to be taken? You need to write this down. Everybody follow along? Am I speaking loud enough? Can you hear me in the back? No? Kinda? Should I stand over there in the middle? To get better sound? Was it better over here? No, not really. I'll try to use, can you take pictures of that too for me? And I would take pictures of these too. So in building a forecast model, what are the first steps or questions that need to be taken? I need you to build a forecast model. Great, what do you want to forecast? First question. Okay. What are we forecasting? And then after they tell you what they're forecasting, what do you think? What do you think drives sales? What do you think drives? Start asking that person if they have a ton of experience. What's the next question I need to ask? I need you to forecast sales for the next 4 quarters. Got it. What do you think drives sales for the next 4 quarters? Got it. What's the next question that comes out of my mouth? What? Huh? How to do it? Maybe. I don't know where to get the data. Okay, where do I get the data? Okay, that could be another. But what's the 2 most important questions that should come out of your mouth? Once they tell you, I need you to build a forecast model. You got it. When do you need it? Okay, when do you need it? What's the other question you need to ask? Which is important. Am I going to do it by myself? Do I have any resources? Will I have other people working with me? Do I have a budget to buy the data if I have to? Those are all the important things that you need to ask. How do you determine the dependent and independent variables? They're going to tell you what to forecast. And if they don't know what to forecast, you're going to go do the literature, you're going to talk to a bunch of people and say, we need to basically be able to forecast performance of the firm over the next 8 quarters. Give me some ideas of what would be good measures of performance for the firm? Profit margin, earnings, revenue, rates of return on the stock, those types of things. How do you determine the independent variables? You ask people, what do you think is going to drive sales? Oh, can I talk to the other senior level managers in the firm and ask them what they think is going to drive sales over the next 8 quarters? And I'm going to go to the research, I'm going to go to the library and look at peer-reviewed journal articles of industry and academic papers that have been published and find out what variables they had in their model that they identified that drove high-tech sales over time. How would you test for variable and model significance? When I run the regression, I'm going to test the t-statistics. And if the t-statistics are greater than or less than 1, start to approach 2. 2, it's a little too much, but anything about around 1 or 1.25 plus or minus, I'm going to use the t-statistic to measure the statistical significance of the independent variable. And for the model's ability to predict the dependent variable, I'm using the f-statistic. Okay. If you were experiencing multicollinearity in your model, and if you had 2 variables that were highly correlated to the dependent variable and correlated to themselves, how would you decide which one to keep and which one to throw out? You basically keep the one that has been cited the most in the literature, in the theory. What is internal and external validity? Internal validity is when you talk to other people internal to the firm with massive amounts of experience to validate your approach and validate your model and validate your results. What is external validity? You go through to the literature and you look at the literature. And if the variables in your model match up with the variables in the literature, you have external validation. Okay? And how would you achieve both internal and external validity? Again, you talk to people, you get validation from them, buy off from senior level managers on your approach with the models, and you go to the literature and you cite the literature within your presentations for external validation to your approach. Unorthodox monetary policy, quantitative easing, and negative interest rates. Here's the gorilla in the room. When I'm talking in front of 300 people or 100 people or 50 people for the real estate community, or I'm talking to economists, or I'm talking to executives that manage companies or large multi-billion portfolios of stocks or bonds or real estate. You want to know about the unorthodox policy that has been conducted since 2008. It's been 10 years since the financial crisis. The financial crisis was the worst crisis post-World War II since the Great Depression. But this time around, when we fell into a severe recession, almost depression, the Federal Reserve decided that what they would do is they would print $5 trillion and basically buy up all of the, or as much of the government debt as possible. Not only government debt issued on the fiscal side, but also government debt external in the marketplace, thereby driving up bond prices really high and driving interest rates to zero and driving the cost of capital to unorthodox levels never to be seen in history. Okay? So the size of the Federal Reserve's balance sheet and the reserves is $5.3 trillion. You can look it up. 5.3 trillion. And the majority of the 5.3 trillion on their balance sheet, about half of it is U.S. government securities, and the other half are mortgage-backed securities. Okay, so the Fed became the market maker in these debt securities because there was no market. Liquidity dried up. We were going into a depression. Okay, so they did unorthodox monetary policy and printed 5.5 trillion and went into the marketplace, bought up as much debt as they could, driving up bond prices and driving interest rates down to stimulate the economy. How much money by banks are being held on reserve at the Federal Reserve? $5.3 trillion. It's the same thing. It's an identity. What was the balance sheet size prior to 2007? 250 to 500 billion. It's basically this amount for 30 years. And the Federal Reserve just held basically $250 to $500 billion in debt securities, basically to buy and sell, to regulate bond prices and interest rates, to stimulate or to contract the economy. Is that a big jump? To go from $250 to $500 billion to 5.3 trillion? So the balance sheet basically increased by 5 to 10-fold. Okay? We've never been here before. And you think it's bad here, it's just as bad in China, it's just as bad in Europe, it's just as bad in London, in the UK. How the top 5 central banks in the world have accumulated over $30 trillion in reserves and on their balance sheets. We've never been here, and they're unwinding it. Okay, I'll get into that. What has been the growth rate in the money supply since 2007? Okay, so in 2007, during the depths of the recession, 2010, the money supply, okay, the growth in the money supply, basically averaged around 30 to 40% growth rate in the money supply, which is really super high, okay? And then from 2011 to 2013, the growth was around 8% to 10%. And then from 2014 to 2018, the growth rate now is 2% to 5%. Now, the growth rate in the money supply is highly correlated to stock prices and real estate prices. So if the money supply growth is decelerating, what does that tell you about the prospect for continued rise in stock prices and real estate prices going forward? Money supply looks like this. Monetary base has increased significantly over the last 10 years. If you look at the stock market, it goes like this. It totally tracks the monetary base and the money supply growth rate. So if the money supply growth rate is actually starting to decelerate, and actually the balance sheet is starting to drop, now we're starting to see this. Stock prices are highly correlated to the monetary base. Stock prices are highly correlated to the growth rate in the money supply. If the growth rate in the money supply is decelerating and the monetary base is contracting, what does that tell you about stock prices and real estate prices going forward over the next 3 to 5 years?
Oh, yeah.
perfect. Okay, got it. Has the Fed hit gross domestic product, employment, and inflation targets? Okay, this is gonna be tomorrow night, right? Janet Yellen gonna be talking about all of this stuff, right? So GDP in the first quarter of this year, 1Q 2018, annualized year over year was what? 2.9%. 2.9%. Okay. The target is 2%. Sorry, the target is 3%. Got it. And actually, the prior quarter was even higher than that. So basically, are we basically at the target? The Federal Reserve is targeting 3% GDP. We basically had 3% GDP in the first quarter. Are we hitting the target? Yes. Okay, so we hit the target. Got it. All right. And what's the next one? Employment, unemployment. Unemployment target, 5%. Where's the current unemployment rate right now? What is it? Isn't it like 3.9, something like that? 3.9%. Did the Fed hit or exceed the target? It exceeded the target, right? So yes. Got it.
Is that the target for unemployment?
This is the unemployment rate. This is GDP. And this is employment or unemployment. So the Fed's targeting 5% unemployment, but we actually have 3.9%. So if the employment rate drops really low, what happens to wages? It goes up. Is that inflationary? If wages go up, does that cause prices to go up? Yes. Does that cause inflation to go up? Does that cause interest rates to go up?
Yes.
Okay. So yes, they've hit the target. They've exceeded the target on the employment levels. And then inflation. Target on inflation is 2%. The current CPI, Consumer Price Index, is 3%. Did the Fed hit or exceed the target?
No.
Yes or no?
No.
The target's 2, they're getting 3.
Oh, yeah.
Yeah. All right. So the Fed hit the GDP target, they've hit and exceeded the unemployment rate, and they've hit and exceeded the Consumer Price Index. What's the Fed gonna do with interest rates? Are they gonna raise interest rates or lower interest rates? They're gonna decrease interest rates. Because they're gonna lower the inflation rate. Okay. So the question then becomes, did they hit it? Yes. If we fall into a recession, would the Fed use negative interest rate policy? Yes. Yes. Okay. They drove interest rates to 0 in the financial crisis. Europe and Japan drove interest rates negative. Janet Yellen, who's speaking tomorrow night, basically went to the banks when she was heading up the Federal Reserve and said, you banks, stress test your balance sheets under a negative interest rate policy, because if we fall into a recession, since interest rates are so low, we may have to drive them negative. Okay, so the answer is yes. What would the impact on the economy, asset prices, savers, investors, and businesses be if we go to negative interest rates? Okay, so let's first talk about the economy. So if interest rates fall and go negative, my cost of capital gets really, really cheap. Okay, so is that going to stimulate the economy? If interest rates get really, really low and negative, and it becomes really cheap for me to borrow, am I going to borrow more or less? I'm going to borrow more. Am I going to invest more or less? More. And if I invest more, is that going to stimulate the economy and cause the economy to grow? Yes. So negative interest rate environments will stimulate the economy. Okay? Will stimulate the economy because interest rates are so low, the cost of capital is so low, and people will borrow, and corporations will borrow because the cost of capital is so cheap. Okay? And they will invest in consume. So it'll be stimulative for the economy. What about asset prices? Okay. Well, here's your basic asset price model. Earnings per share, and I'll get into this a little bit later. Forward earnings per share divided by some expected return is going to equal the value of a stock. Okay, and we'll assume that the earnings per share is going to be constant over time. This is your basic perpetuity valuation equation. Okay, so if interest rates go low or go negative, what happens to the discount rate or the expected return? Is it going to go up or down? It's going to go down. And if this goes down, what happens to asset prices? It goes up. It's a basic equation. Okay, it's a basic equation. So if the Federal Reserve decides to implement negative interest rate policy in the next recession, they will drive interest rates negative, drive down expected returns and the cost of capital to prop up asset prices. Okay, to prop up asset prices. And that's what they did in the recession. That's what they did in Europe, that's what they did in China, that's what they did in Japan, okay, and other places. What would it do to savers? Now I'm a pensioner, I'm retired, I want to buy some bonds, okay? So I'm buying bonds at negative interest rates. Am I happy? I'm destroying wealth. I'm not getting a rate of return on my bonds that I'm buying. I'm actually getting negative interest rates. So I'm buying government bonds that are yielding negative interest rates. Am I happy? No, I'm getting destroyed. Okay? That's why the people, the investors, the savers in Japan are going literally nuts. Okay? Because they save a lot of money, they invest a lot of money, they buy government-backed JGBs, Japanese bonds, at negative yields. And it drives them freaking crazy. Because they know that at the end of the day, between inflation and negative interest rates, they're not going to have enough money to live in retirement at the standard of living they're accustomed to. Negative interest rates are horrible for savers. What about investors? Well, if I buy stock, or I'm buying real estate, net operating income, some cap rate, well, if interest rates go negative and go low or go negative, it's going to drive down the cap rate, drive down the discount rate, drive down the expected returns, and drive up my real estate prices and drive up my stock prices. So the investor class is going to benefit significantly in a negative interest rate environment by propping up the asset prices. And if you look at since 2009, people who had stock, people who owned real estate, saw their money double and quadruple. People who didn't own real estate and didn't own stocks got destroyed. Okay, they got nothing.
So wouldn't you rather be like an investor then? What's the
You
point?
want to be an investor.
But then, and then
You want to be
not say,
buying bonds first. So as interest rates go down, the bond prices go up. Once the prices, the interest rates bottom out, okay, and once the economy starts to recover, then you buy real estate and stocks. And you sell off your bonds, you buy real estate and stocks, and ride the upwave. And that's what people have done since 2009, so the last 10 years. If you were in stocks or in real estate, you saw your money double and quadruple. Okay? So if you're part of that class, you totally benefit. So investors benefit. Businesses, because of the negative interest rates, their cost of capital, when they raise bonds and they raise equity and they borrow from the bank, is extremely cheap. So the businesses can borrow cheaply and invest and drive profits and invest in productivity and equipment and drive profit margins. And so businesses benefit too. So it's the savers that get screwed in the process. Okay? That's that. Yield curve dynamics. Any questions on this? Okay, I'm giving you the, you want to take a picture of this before I erase it? talk about investments, you can't talk about financing unless you understand this stuff. The book is just so narrow. What I'm giving you is an organic macro view, and then we're gonna drill right into the finance. And the book does a horrible job of it. So I've spent the last 4 years modifying the book and bringing in my content that I think gives you more tools to be able to make decisions at a strategic and a tactical level, which is where you're gonna be within the next 3 to 5 years, all right? So the next one is the yield curve dynamics. Did I show you the yield curve? Did I show you the yield curve? Did I show you the yield curve last week?
No.
No? Okay. What I want you to do is I want you to type in to your URL, I want you to type in dynamic yield curve. Dynamic yield curve. Dynamic yield curve. And you're going to click on where it says stock charts, dynamic yield curve, stock charts, click on that. And you should get this, this graph. This is what I think is one of the most important takeaways from the class, okay, is this section right here. So here's the S&P 500, this is the stock market index, going back to 1999, okay? This is the yield curve right here. The yield curve is interest rates and maturity of the bonds. Short-term maturities, because each bond has a maturity. Could be, I can buy a bond, maturity is 3 months, 6 months, 9 months, 1 year, 3 years, 5 years, 7 years, 10 years, 20 years, 30 years. So the maturities go out as far as 30. So for each bond, for each maturity, there is a given interest rate, okay? And these are U.S. Treasury securities issued by the Treasury. These are risk-free U.S. Treasury government sovereign bonds, okay? This is the U.S., all right? And this curve right here, as you can see, is upward sloping, okay? But it's almost flat, all right? So this is a key component. So here, what you're gonna find out is during the stock market peaks, okay, the yield curve is gonna flatten. And then as you start to approach the peaks, the yield curve is going to invert, and short-term interest rates are going to be higher than long-term interest rates. And then all of a sudden, the stock market bubble pops, okay, and we start to go into a crash, and we start to go into a recession. And then the Federal Reserve starts to buy up those bonds on the short end, driving up bond prices and driving down interest rates, and causing the curve to basically become normal, steep, and upward sloping, okay, to stimulate the economy, to keep the stock market from crashing, and the economy from going into a prolonged, serious recession or depression. Then, as interest rates are low, people start borrowing, investing, and consuming more, the economy starts to take off again, and as you start to approach the other peak, the yield curve flattens, inverts right prior to the peak, and then the Fed pops the bubble, takes away the punch bowl from the party, and then we go into a crash, again, a correction, and then they start buying up a bunch of short-term bonds to prop up bond prices and drive interest rates to 0 or maybe negative next time. But the Federal Reserve has kept, as you can see, since 2014, has kept interest rates low for too long again, and has created an asset price bubble in stocks and in real estate. We've never been here before. Look at it, straight up. Is that normal? Can we continue to go forever? Will this slope go up there forever? No, you gotta be smoking something. If you think, you gotta have a really good vape, if you think that the stock market is gonna continue to go up forever like that, okay? So it's not. So what you need to do is click on this animate right here. Right here, this animate, right there. Click on it. And here in 1999 and 2000, as we started to approach the peak in the stock market and in the business cycle, the Fed was selling off the bonds, driving down bond prices, and driving up interest rates. Now watch what happens as we get towards the peak. Tell me when the curve inverts. Boom, done, it inverted. We go right into a recession and the market corrects. Then the Fed starts to print money, buy up the bonds, drive up bond prices, drive down interest rates to stimulate the economy, put a floor under stock prices and real estate prices, and try to get the economy from stopping in its contraction and starting to get it to grow again. So now the curve is pretty steep, right? It's upward sloping, and short-term interest rates are extremely low, trying to stimulate the economy through borrowing, investment, and consumption. Once the economy starts to take hold, and the stock market is in a solid upward trend, as you can see, they'll start selling off the short-term bonds, driving down bond prices, and driving up interest rates to regulate the economy and keep it from overheating and keep the stock market from being in an asset price bubble. So as you start, tell me when the curve inverts and tell me when we peak in the stock market. So tell me when the curve inverts. When does it invert? Right now. So it inverted, stock market peaked within less than 12 months. We were in a recession in less than 24. So right now, the difference between long-term rates and short-term rates is the narrow it's been in 9 years. And the Federal Reserve, Jerome Powell said that they will raise interest rates another 3 to 4 times by 25 basis points, which means the curve will probably invert next year or later this year. Okay? And we're selling, and the Fed's selling off a lot of the bonds that are sitting on the balance sheet, and we're going to run a $1.2 trillion deficit to add to the government debt, and we probably have another $1 trillion or 2 that need to be refinanced. So there's a lot of paper coming out over the next 12 to 24 months that's going to need to be refinanced, and all that paper is going to drive down bond prices and drive up interest rates. This is what everybody's talking about. And I've been talking about this for 5 years. Okay? We're just closer now than we've ever been in the cycle. So that's why it's important to study yield curves. Okay? So using the Fisher equation, so the yield curves, as we know, the yield curve is upward sloping. Like that. Okay? And you got the maturities down here, and you got the associated interest rates. Now, we talked about last class that the equation that determines nominal interest rates is the Fisher equation. And the Fisher equation basically states that nominal interest rates equals the real rate plus inflation expectations. Not inflation, inflation expectations. Okay? That's the Fisher equation.
Does that stand for nominal under?
Yeah, that is the nominal. Nominal interest rates. And this is a very simple equation for the Fisher equation. It's mentioned in the book, but it's not what we talked about and really gotten into. Okay? And this is, I think, really important so that when we go forward in the class, we have just a solid macro financial economic grounding to be able to understand the book. Okay? So nominal interest rates, okay, these are your, and they're also called yield to maturities on the bonds. So for each interest rate, you could have the 3-month, the 6-month, the 9-month, the 1 year, the 3-year, the 5-year, the 7-year, the 10-year, the 20-year, and the 30-year bond. And you're gonna have interest rates associated with it. Now, we know that if the market thinks that the economy is gonna overheat, or that unemployment is really low, and wages are rising and inflation's rising, that's gonna form inflation expectations. So if the market thinks that inflation in the future, due to wage growth or commodity price inflation is gonna drive up prices, they're gonna adapt their inflation expectations. They're gonna think that interest rates are gonna rise in the future. And if interest rates rise in the future, it's gonna cause the yield curve to shift up. Okay. And if the yield curve shifts up based on the equations that we had before, either net operating income or earnings per share, interest rates are going to go up in the future because of higher inflation, then our expected returns on our discount rates are going to go up too. So if the yield curve shifts up because of higher inflation expectations, it's going to make stock prices, probably drive stock prices, bond prices, and real estate prices down. And the opposite is the effect. If we see, because we're going into a recession or something, and we see prices start to fall, or the rate of inflation start to slow, and wages start to fall because of higher unemployment rates or lower GDP, then as the inflation expectations are adapted or revised down, that's going to cause the nominal interest rates to go down. It's going to cause the yield curve to shift down, and it's going to prop up the prices for real estate stocks. Now, here's the issue, here's the problem. That's very simple, okay, but that's not the reality of the yield curve dynamics. The yield curve can flatten, which it has due to higher inflation expectations and interest rates. So what we've seen is we've gone from what is called a normal sloping yield curve to a flattening curve, flat curve. And the other is the Fed, which they do, they make mistakes, they oversell the bonds, particularly on the short end, drive bond prices down too far, drive up short-term interest rates too fast, too far, too high, that they invert curve. They invert the yield curve. As you know, from here, once the yield curve inverts, the stock market peaks in less than 12 months, and we're in a recession in less than 24. Okay. Using yield curve theory, going back to 1955, and I can go back another 100 or 150 years using other types of yield curves, and it's the exact same thing. It's the #1 predictor for recessions. So we got an upward sloping curve, we got a flat curve, we got an inverted curve. Okay.
Sorry, I have a question.
Yes, sir.
EPS thing.
That's the earnings per share expectation. And this is net operating income for the real estate. And these are assumed that these earnings per shares and these net operating income are going to be stagnant in the future. So any movement in interest rates is going to cause the values of these asset classes to go up and down. So the #1 macro factor that drives stocks, bond, and real estate prices up and down is monetary policy and the yield curve. Okay. And they only mention that in like one little section of the book. Okay. Using the Fisher equation, what variables drive risk-free rates, nominal interest rates on U.S. Treasury securities up and down. Real rates and inflation expectations. Now, real rates don't move very much, okay? So basically, real rates in the short term are constant. So the number one factor that drives nominal interest rates and shifts the yield curve is inflation expectations. It's the number one factor. That's why everybody focuses on it. Everybody looks at it. Okay, show the equation, boom, and graphical representation of a normal upward sloping curve, flat curve, and an inverted curve. What are the three yield curve theories? There's three theories. There's actually four yield curve theories. And actually what I like to do next to, in my book, is I like to show the yield curves like this. Show upward sloping, flat, and inverted within your booklet. And then you show me the Fisher equation, IN equals real rate plus inflation expectations, and the inflation expectations are negative. Okay. And then over here, IN equals the real rate plus inflation expectations, and inflation expectations when the curve is flat is 0. And then the last one is IN equals the real rate plus inflation expectations, and in this case, inflation expectations are positive. So that's what I like to see in the book. So that one and then this one. There are 3 or yield curve theories. One is called the expectations hypothesis. Okay, the expectations hypothesis. One of the 3 theories, and I usually like to write out the theories like over here. So under the yield curve theories, the expectations hypothesis is really the Fisher equation. So what drives interest rates is really inflation expectations. So that's the first. The next theory is market segmentation. Market segmentation. Liquidity preference. And preferred habitat. So there's really 4. There's 4 yield curve theories. And basically the expectations hypothesis states that yield curves shift up and down and flatten and invert and become normal based on inflation expectations. It's basically what drives and moves them. The market segmentation, liquidity preference, and preferred habitat are basically very similar. Okay? And the theory behind them basically states is that the yield curve is broken up into 3 segments. Short-term bonds, medium-term bonds, and long-term bonds. So there's different supply and demand dynamics based on the different segments along the yield curve. And if I'm a pension fund, I'm an institutional investor that has very long-term liabilities, I want to be buying long-term bonds to match my assets and my liabilities as they come due. Corporations like to borrow on the short end of the curve because of the inventory and the short-term nature. And because if they borrow on the short end of the curve, interest rates are usually lower and their cost of capital is cheaper by borrowing on the short end. Okay? And then you're going to usually finance your inventories with short-term debt. You're going to finance your equipment machinery with medium-term debt, and then you're gonna finance your plant, your real estate assets with long-term debt. Again, you wanna match the short-term, medium, and long-term assets, asset lives with the liability maturities, okay? But here's the thing that you need to understand, is that the Federal Reserve does not control medium and long-term interest rates, they control short-term interest rates, okay? They control short-term interest rates through open market operations, by buying and selling bonds in the open market through the Federal Reserve Bank of New York. And the Federal Reserve will buy and sell the bonds to drive bond prices up and down, interest rates up and down, to either stimulate or cool the economy. Okay? So this is where monetary policy lies, by the Federal Reserve. Okay? And that's why it's important. So what impact do movements and shifts in the yield curve have on asset prices? We already talked about it. So if the Federal Reserve is buying a bunch of bonds, it's gonna drive up bond prices and it's gonna shift the yield curve down and it's gonna drive asset prices up. If the Federal Reserve wants to cool the economy, they're gonna sell a bunch of bonds, it's gonna cause bond prices to go down, interest rates to go up, the yield curve to shift up, and it's gonna cause asset prices to go down. Okay. How does the Federal Reserve influence interest rates through open market operations? By buying and selling bonds to drive bond prices up and down, to drive interest rates up and down, to basically stimulate or cool the economy. Yes.
So again, you said, what policy tool do they use?
They're gonna use open market operations, okay? Open market operations is the #1 tool that they use. Okay. What is the objective of buying and selling bonds? To drive bond prices up and down, interest rates up and down, to stimulate or cool the economy over the business cycle. Got it. If the Fed buys and sells bonds, what is the impact on bond prices? Well, if they buy bonds, bond prices go up and interest rates go down. If they sell bonds, bond prices go down, interest rates go up. Okay? What is the impact on interest rates and yield maturities? I already told you. Does the Fed control and influence directly short-term interest rates? Yes. Do they control and influence long-term interest rates directly? No. They do it indirectly. They do it indirectly. Okay? Got it. Next question. What were your overall observations of the relationship between the correlation between the yield curve and the S&P 500? Was it positively correlated or negatively correlated? If the yield curve goes up, then stock prices normally go. Sorry, if interest rates go up, then stock prices normally go down. And if interest rates go down, stock prices normally go up. Is that a positive correlation or negative correlation? Negative correlation. Excellent. Did the yield curve lead or lag the peak of the market? It led the peak. Okay. If it did, by how many months? When the yield curve inverted, the stock market peaked in less than 12 months. If the yield curve inverts, the economy goes into a recession in less than 24 months, period. Can you use the yield curve to predict stock market peaks and recessions? Yes. By how many months? 12, less than 12 for the peak, less than 24 for the recession. Okay. Got it. Why is it important to track stock, bond, oil, and gold prices and the value of the US dollar relative to foreign currency? Why is it important to track those 5 asset classes? Because the majority of global wealth are in those 5 asset classes. And trillions and trillions and trillions of dollars are not only invested, but trillions and trillions and trillions of dollars are traded each day in those asset classes, and you, as an investor, will be exposed to those 4 asset classes. You personally and your companies. Where are these asset classes trading today? Well, we know that the Dow Jones is trading at what, 26 something,
Yeah,
right?
64.
Oil prices are what, What was it? Yeah, 68 something. Gold prices are around 1,200. The 10-year treasury yield is around what? Is around what, 2.88, didn't you say? Almost 3%, around 2.88. And then what was the dollar to the pound and dollar to the euro? It's like at 1.16 for the euro and 1.2 something for the pound, something like that. Yeah. So that's what I'm looking for. And can you tell me why they're up or down? I'm looking to see if you've done some research and read some of the articles. Okay. And it'll tell you in the article. Okay. What drives these prices and values up and down? And we know earnings and interest rates drive stocks. Inflation drives gold. Geopolitical risk will drive gold. If we get into a war with Iraq and they shut down the Straits of Hormuz, oil prices are going to spike due to supply shocks. And so there's a lot of macro factors that drive these asset prices up and down, along with supply and demand, obviously. Okay, and then give some examples. Dynamic asset class supply demand analysis. Okay. I think what I'm going to do is I'm going to end it after this, because I only have a few more, and then I'll try to get through as much of this stuff as possible, and whatever we don't get into, we'll throw it into the midterm and stuff like that, okay? All right, so this next piece, the supply-demand dynamics, the dynamic asset class supply-demand analysis, this is really important because this is the underlying fundamental microeconomic analysis that you're going to use to be able to forecast the asset class prices for your memos. So you need these models embedded in your brain so that then you can move forward to apply the microeconomic analysis to then make the forecast of where you think these asset prices are going to go over the next 3 months. Okay? So basically, the way that it's set up, does anybody want to take a picture of that before you're I'm going to try to go through this pretty quickly so you can get out here. And then I'll get here early and I'll start putting some stuff on the board next Tuesday, and we'll go through the rest of this. Okay? We'll do the best we can. All right. So supply. Demand. Has everybody taken microeconomics? What's this? Got it. Demand. What's this point? Equilibrium. What's this? Price. What's this?
Quantity.
Quantity supplied. What's this?
Demand. Quantity.
Demand. And then equilibrium. And then price. So that's basically it. So you start off with the markets in equilibrium, and then you start shocking the systems. Okay? So the first thing we're going to do is stocks. Okay? And we're going to do supply shocks, and we're going to do demand shocks. Okay? Let's see if I can do this. All right. So the first thing we're going to do is we're going to do stocks. Okay? Okay. Now, what happens if all of a sudden you get a wave of initial public offerings, a wave of secondary and seasoned offerings in the marketplace? What's that going to do to the supply curve? Where people start selling off stocks in the marketplace. What's that going to do to the supply curve? It's going to shift it back or shift it out? Shift it back or out? 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 Out. Got it. Okay, S1. Got it. So if the quantity supplied shifts out, the price is gonna go
Down.
down. Everybody should be doing this sing-along, this microeconomic sing-along. Prices are gonna go down. So these are gonna be due to initial public offerings, secondary offerings, or a sell-off in the stock market will cause the supply curve to shift out, quantity supplied to shift out, and the prices to drop. Got it. Okay. Then the other is what would cause the supply curve to shift back, quantity supplied to shift back, and prices to go up. The number one factor, stock buybacks. Stock buybacks. I think that most of the major companies right now have issued all kinds of really cheap debt, gone into the marketplace, bought their stock back, retired their stocks, shifted back the supply curve, propped up stock prices artificially through stock buybacks. That's the number one factor. Okay. What would cause the demand curve? What would cause the demand curve for stocks to shift out? Well, the demand curve shifts up, and the quantity demanded is going to shift out, and the price of the stocks are going to go up. So what's going to cause the demand curve to go up for the stocks? Well, one of the factors that would cause stock prices to go up is lower interest rates, higher earnings, expectations, one, and low. How about high bond prices? If I think interest rates have dropped to the very lowest and stock prices are really high, bond prices are really high and stock prices are not relatively as high as bond prices, I'm going to sell off my bonds at a high price and then buy stocks at a low price. Okay. So that could cause demand for stocks to increase and the prices to go up. What would cause demand for stocks to drop? You just reverse it.
Yeah, increase in interest rates.
You just reverse the logic. So you go higher interest rates, lower earnings per share expectations, and low bond prices. And then the other is actually, which I think is more important than this, is going to be, no, actually this one here, higher GDP, overall economic growth. And then down here is going to be lower GDP, cause the demand curve to shift down. Quantity demanded, shift back, and the price of stocks drop. Okay, get it? Yeah, those are the factors. All right. And then the next one is we're going to do, what do we do now? Oil. So we do oil. So what would cause the supply curve for oil to shift out, quantity supplied shift out, and the price to drop? How about they're talking about a sell-off in the strategic reserve. The other is fracking. Right, overproduction. Right, and then what about OPEC? the supply shock. Okay. What would cause the supply curve to shift back? Just reverse it. Okay. Buying strategic reserve, falling fracking production, and OPEC cutbacks. It would be all factors that would cause the supply curve to shift back and the prices to go up. On the demand side, what would cause demand to go up? Higher global GDP. Higher global GDP in most cases. Okay. You might find other factors too, there too. And then what would cause the demand curve to go down? Global recession. Alternative renewable energy, electric cars, yeah, those kinds of other factors that cause demand for oil to go down. What's the next one? Gold? What's the next one? Gold. What would cause the supply curve to shift out for gold? Higher extraction, and how about mining and technology, advancements in mining technology, easier to pull the stuff out of the ground. What would cause the supply curve to shift back? Oh, I got another one. Another one that could cause the supply curve to shift out is a sell-off by central banks. And treasuries. Because governments hold gold to anchor their currencies. And it's a store of wealth, and it's a commodity. They can use it for liquidity purposes too. Okay. And then what would cause the supply curves to shift back? One would be central bank hoarding. Can anybody think of anything else that would cause the supply curve for gold to shift back? I can't think of.
Like,
Does that say holding?
Yeah, central bank holding. Of gold. Maybe if they're holding more and they're not letting, as much out, they're not pushing up the supply curve.
How about the war?
Huh?
How about the war?
Could be. Supply curve could shift, but that's gonna be on the demand side. Okay, not the supply side. Okay, so let's do that. So what would cause the demand curve for gold to shift up? War. Geopolitical uncertainty cause people to go into gold as a fear factor and a store of wealth. Hyper or high inflation. If you were in Venezuela, could you imagine inflation at 1,000,000%? Yeah, you're totally wiped out. Okay. So higher inflation would cause demand to go up. Also population growth. Yeah, particularly in China and India. Because they use gold as dowries for marriages, and they transfer between families. Culturally, it's a store of wealth. So population growth and economic growth in those countries make them more wealthier. Okay, and they're going to buy more gold. Okay. what would cause the demand curve to fall for gold? Again, let's just turn it around. Right? So it would be peace, right, in the world. You would have disinflation, falling prices, population contraction. Gold is also used in inputs into particularly semiconductors and in electronics. So we could probably use, higher GDP, and we could probably use falling GDP as some factors. What's the next one? Bonds. So what would cause the supply curve to shift out for bonds? Government budget. Government budget deficits. Push the curve out. Law by foreign governments. The foreign governments, if China or Japan decide to sell off and stop pegging their currencies to the US dollar and using the US Treasury securities as a way to immunize and peg their currencies below the purchasing price parity, they'd sell off the bonds. What would cause the supply curve to shift back? Budget surpluses. If we run a budget surplus, we're going to go into the marketplace and we're going to buy, and we're going to retire the bonds, like we did under the Clinton administration for a couple of years. Okay, so budget surpluses would do that too. Okay. I don't know, there may be some others, but I can't figure it out. What would cause a bond price, the demand for bonds to go up? Geopolitical risk. When people are scared, they go into bonds. They sell off stocks and they go into bonds. What would also cause bond prices to go up? Low, falling, inflation, and interest rates. Would also be another factor that would cause demand for bonds to go up. What would cause the demand for bonds to go down? Geopolitical stability, high and rising inflation and interest rates. Maybe some other factors, but those are the number one factors that I came up with. Okay. And now the US dollar, and we'll end it there, USD. US dollar. We're going to do the US dollar. But always remember the movement in the US dollar is inverse to foreign currencies. So if the US dollar appreciates, then foreign currencies depreciate. Foreign currencies appreciate, US dollar depreciates. In foreign currencies, the FX, it's used for foreign currency. We're almost done. What would cause the supply curve, and then actually what you have to do is when you shift to currencies, you don't use prices anymore, you use values. So you have to change these to values. Because the currency, we're talking about currency values, not currency prices. Okay? So we have to change this to the values. Values. Now we can talk about currencies. So So what would cause the supply curve for the US dollar to shift up? Okay. How about, oops, get my things right. Accommodated monetary policy. So what we're trying to do is we sell off the dollar to drive down the value of the dollar to spur exports. Basically accommodative monetary and fiscal policy where we're flooding the market with dollars to drive down the value of the dollar, to make the dollar cheap, to make the exports cheap, to stimulate GDP. What would cause the supply curve for the US dollar to shift back? This could also be sell-off by foreign governments and investors. They can also sell off the dollar too. And then what I would do is I would flip it. So I would go, and accommodative monetary policy also is going to be lower interest rates. Okay. So we flip it, and we go restrictive monetary fiscal policy and higher interest rates. As interest rates go up, let's say in Japan, interest rates are really low, and over here, interest rates are really high. Where are you going to invest your money? Over in Japan at low interest rates, or in the United States at high interest rates? You're going to sell off the yen, and you're going to buy the U.S., sell off the yen and the JGBs, the Japanese bonds, and you're going to convert into dollars. It's going to cause the dollar to appreciate, the yen to depreciate, and it's going to cause bond prices to, or stock prices to go up, or real estate prices to go up. Okay? It's going to cause the currency to appreciate because of higher interest rates. Another reason, I'll do it on the demand side. So what would cause the demand for the US dollar to go up? One would be higher interest rates. You gotta watch these because this is important. Higher demand for the dollar, higher interest rates, higher productivity. That's labor. That reflects in higher profit margins. Higher returns, stock, the real estate market. Because why would you invest someplace else when you can get higher real estate and stock returns and bond returns here than someplace else in the world you wouldn't? You'd sell off their currencies and you'd buy into the US market, into the assets, and that would drive up the US dollar. It would cause it to appreciate. And then you can flip it. What would cause the demand curve? Oh, the other one that's important too is higher production or GDP. And then that's all you got to do is flip it for it to cause the demand curve to shift down. So it's going to be lower GDP, lower interest rates. Oh, I got another one. Lower productivity and lower returns. I got another one up here. Up here, it's gonna be lower inflation. Because if we have lower inflation here, the rate of deterioration in the purchasing power of the dollar is gonna be less than someplace else. So people are gonna wanna invest in the dollar. And then over here, it's gonna be right here. Higher inflation. So when you read the articles for your memos, they're gonna talk about these factors. And then they never talk about, you know, they assume that you already understand the microeconomics behind these asset classes. This is basically the menu of factors. They're gonna shift the supply curve back and out, and the demand curve up and down. That are basically gonna be the factors. They're gonna drive these asset prices up and down. And you're gonna program this in your brain, so that when you go read and research for your memos, these are the models, this is the model that's going through your brain to be able to forecast where the prices are gonna go, up or down, by some amount. Stock prices can go up and down over the next 3 months by 10%, plus or minus. Oil prices, gold prices are not only gonna move around maybe 3 to 5%. Okay, currencies, maybe 3 to 5%. And then 10-year treasury prices, maybe 3% around there. So that's kind of the limit, okay, for those, for your forecasts. And really, at the end of the day, just as long as you're in that bound of forecast ranges, you're okay. It's really the direction, either up or down. You guys are awesome. That's a lot. So we'll go through the engineering. We'll get through probably the intrinsic values, work through some problems. We'll be done with the quiz next week.
So with like lower interest rates,
Thank you,
how
everybody.
like the housing market